U.S. added 142,000 jobs in August. Yes, less than expected. And they also revised July downward. But big picture, it is not a surprise. Not any of it, right? Non-farm payrolls unemployment rate triggers 4.2% as expected. It was 4.3%, which was a big jump from 4.1%. And I really, whether it was weather related or other, was absolutely expecting it to come back down into 4.2%. So what we have are really no surprise, not any of it. So we've got a little bit of a, shake and bake initially on the report. You got to kind of calm down, pace yourself type of thing. We had nothing really in dollar or gold except for this big candle, but I'm talking about 100.5 didn't change, 2500 didn't change. We definitely have SPY 545 and QQQ 455 holding, and even forming a little bit of a Morningstar reversal on the 2-hour. This is pre-market look, obviously. Oil had already fallen and has not gotten back up, which is that 70 mark. And yields did a big shake and bake. Not a surprise that they're bouncing. Like literally not a surprise they're bouncing.
This short clip is presented by Club. Club provides access to Samantha LaDuc and her team of professional macro and micro traders, analysts, and educators. Club is ideal for active traders, investors, and institutions who want Samantha's best-of-breed market timing calls across all asset classes and timeframes like chase, swing, and trend. Get the trade before it happens. Sign up to Club now and get full access to daily live trading room with Samantha LaDuc, Slack trading desk with detailed analysis and trades, custom trade support when you need it, and much more. For more information, visit www.LaDucTrading.com/club.
Check this out. So 10-year yield hit again this 3.678. Now 3.678 is a quarterly level, so it just means that it's strong. So hourly levels, day, week, month, quarter, year. It obviously, the older you get, the more influence you have. Quarter's pretty darn strong. So anyway, long story short, we just revisited the August 5th low and we are bouncing. Now TLT, fascinating. Anyway, the prior high, which as you can see over here, which was December of 2023, 100.57. And it also happens to be this kind of magenta line here of the 100 EMA, which we did not tag on August 5th. We did not tag. But we just did pre-market. Look at this over here. Bingo. We just tagged exactly 100.57, which was the December high of 2023, which is also the 100 EMA, which had been price target. We didn't tag it on August 5th. We just did. And we just tagged perfectly the 3.678, which was quarterly support, already tagged on the 5th. You know this. This is like, I think we're going to stabilize on Friday and move into options expiration on the 20th. If the option read is correct, which means basically they were hedging for today, really strongly hedging for today. We're selling into, it's kind of like you buy the rumor, sell the news of NVIDIA. Well, basically they're lightening up and hedging big time into non-farm payrolls before bouncing. So that's sort of script I'm following, and I'm test to see if it's right. Now, big picture, I don't think that this is healthy. I'm actually really bearish underneath. There's tactical trading on short duration, and then there's swing trades and all that jazz, but I'm definitely getting nervous. So I wrote this up just to kind of overview what I'm talking about here. First and foremost, not a surprise, any of it as far as 4.2%, FOMC expectations for a bigger cut, the 10-year back to that quarterly support, the TLT tagged exactly, the yen rallies, the dollar yen tagged the 142, which we've been talking about exactly. So all this stuff has to hold, obviously, for the bounce thesis, but that's not what I'm talking about so much. And by the way, if you're really wanting to get into the weeds of the labor market, Claudia Sahm does a great detailed analysis, where to be worried, where not to be worried. The Fed definitely should cut. The Fed should cut more if some of these indications appear, which is if we get a rising unemployment rate, which obviously we don't have this particular month. The point is she's looking forward on what to look for more concerns of pulling forward recession risk, which I feel very strongly is coming, but we don't see it yet. The market doesn't see it yet. So the point is she's saying, hey, rising unemployment rate without increased participation. Now, we had pretty lousy participation in this report, FYI, but again, not danger level, or some other special factor would be cooling demand. So in other words, job demand, remember my worldview, the top 10, right? And I said we're about halfway there until we get into that falling jobs demand. Yeah, so she's saying the same thing. That would raise the risk of substantial labor market weakening and point to larger rate cuts. So now we have to pace ourselves because this could be another month or two because again, we still have the election. So to me, this is a little bit of musical chairs and timeframes matter. On a short duration time frame right now, you can see where dollar is fine. The markets are trying to stabilize, yields too, and we've got Bitcoin right on this trend line. Let's see what happens. And we got a lot of very bearish weekly charts that need to get repaired. Big picture, semis, Mag 7, all that stuff. This little growth rotation, it's trying to stop going down so it can rotate higher. And with that, we actually did start to see some rotation, right? But point is, I go through my thinking about, okay, we still have this stuff working. Some of the strongest stocks within the strongest sectors, and they are working. I'm not saying to like move away from that and go into growth. I'm actually not saying to go into growth. I'm saying for a rotation, we could absolutely have a strong bounce like you've seen in Tesla. But the point is a little bit more. But big picture, I don't trust it. Like this euphoria of all things AI, mega cap tech and semis, which has been that RSP rotation, shows the concentration risk. That shows that it's absolutely not a durable long. It's just not. I can see that we're losing momentum, money flow, sponsorship, also the gamma option, the crowding out that's happened. And if you're a client for a while, you know I've talked about this trifecta of where they start aggressively buying calls. They are aggressively selling puts. They are literally rolling into the calls that they sell above. In other words, they're getting called on their sold calls, and that forces a dealer to cover by buying more of the stock. So this has been one of the reasons that we've had such an outsized rally, in addition to the Fed, pivot, the Yellen Yahtzee, all of those things are policy interventions, etc. But it's that combo deal right now that I see we're losing that same intensity. We're losing the intensity of the market structure. We're losing the intensity of the Fed put. It has diminishing rate of return. You can see it because they're not in control of the yield market. Yields are falling. This is not the Fed controlling the 10-year. So I am looking for evidence to kind of corroborate my thinking of, is it just me or does anybody else see that the market structure is changing? Remember how I mentioned that was a big blow up. And then August 5th. And then I said, Tuesday morning, this week, I said, something's wrong. Volatility is getting out of control. I see this as dealer hedging. They're off sides. So the point is they're getting more nervous. It's not as easy to short volatility. So suppressing volatility is a key cornerstone of how markets continue to levitate higher and higher and higher. So we're going to have more bouts of volatility. I think there's going to be less crazy buying and less impact from policy intervention. So this is the backdrop that I'm talking about. Can we still grind higher into September 20 OPEX, especially today if the market says, oh, thank God we're past non-farm payrolls. We know what the Fed's going to do. We really just have to square the books, hold our nose, go in there, buy the dip. Absolutely, because everyone is still really betting on an election year that is traditionally, seasonally strong, but only if oil and yields can stabilize here. Several weeks here, we have to stay under 70 in crude and get down to that 65 and take out 65 and then stay under 65. And now everyone's talking about how oil is going to 60. I see a market that has absolutely weakened. The AI euphoria has abated. Bank of Japan policy interventions have diminishing rate of return. I don't see where the forward growth excitement is going to come from. That has completely led this growth rally higher. But remember, if you take out the Mag 7, year-to-date earnings have been negative 7%. That's a big outlier. They're not doing so hot. So it's all about stepping away, pulling back, and saying, hey, wait a minute. Yields are not bid despite fiscal dominance. What's up? Dollar is not bid despite supposedly having such a beautiful soft landing. Oil is not bid despite all kinds of geopolitical risk premium. You know my mantra. I believe that rate cuts are absolutely a signal for falling global credit demand, period. That's not bullish. I don't think that we're out of the woods here with having more bouts of volatility and bigger consequences for this reversal of the higher for longer that, by the way, has not become consensus. Take care on some of the sector rotation trades that have been very, very defensive, because we do have a little bit of a rotation here potential if this can curve around and start moving higher. And that means we can go right back up to that 1.95, and then we'll see. Tech would have a little bounce. But in the meantime, I was just sliding down that trend line. So remember when I said I expected 465? We hit that into 460 and a half, and then we had a pre-market dump. I said, next, basically 450, 437 is the daily gap. We hit that pre-market. We still haven't even been able to get up above this hourly trend line. This is what I mean by, come on, this market structure is, I don't know what they're doing. It's just sliding down this trend line. So clearly we're heading back down to this 450, 437 until it hits. Market just does not feel the same. Buyers are stepping away. Traders are stepping away. And yet everything I read on the options market is bull, 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 bull. I just think the market structure has weakened and we need a macro trigger for higher. It used to be we needed a macro trigger for lower, right? To interrupt the bullish flows. I don't see the bullish flows anymore. Even on a daily basis, they have been coming in here every single day and selling calls, selling calls, selling calls. I'm telling you, this is flipped. Now, what would be ideal? Let me tell you what would be ideal for bulls. I really hope we get a Monday morning gap down. Yep, I really, really do. I hope we get a Monday morning gap down and then we begin to heal. Fridays are typically like the end of a particular move, and this week has been horrific. There's Tuesday, Wednesday, Thursday, not much, and now this is going to equal this, but do not be surprised if we go tag that 450. 499.34 would be perfect, but they will start to monetize the puts at 450. And the morning, I clearly saw the call selling that came in. So that's it. I really think that this is not a safe market, big picture, but it would be fabulous to have a washout, Monday morning gap down, and then we start to repair. I don't know if we're going to get it, but you know, that's the best bet I can think of for bulls. This is an area in SPY. This is a gap fill, 545, where we were earlier, and the 55 days here, etc. 540 is the measured move that I see for today. If you are looking for a chase short lotto, 540, I'm seeing it for today. Absolutely. As a lotto, QQQ, that's pretty easy. 450 is a level of support. For SPY, it'd be 540.30 is the exact. But for your option strike, 540. For Qs, 447.30. That's a lot, but that's what it says. Measured move for today, potential overshoot. So I'm not gonna get too excited here because you know I already have 450, highly recommended as a lotto for today. 449.34, 440, they're here, right here, daily or weekly, it's kind of the same thing. But if you're looking for an overshoot, because it's 10:44 a.m., we could absolutely have a measured move overshoot of 447.30. So for those of you who chase or who are pressing short, that is the level where I would expect a quick monetization of puts, or that's where you would trail your profits. 451, 450, 449, leave a little runner to 447.30. Just for giggles.
Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.